one of the superpowers of investing and trading is to respect risk. Warren Buffett has 2 rules to investing. Rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. But what's one of the best ways to make money is to make sure you preserve your capital when the environment is not ideal.
Last Week in the Market is now Right of the Chart, the podcast for self-guided independent traders. Hey everybody, thanks for joining the podcast. Today I am Sean Vincent. I am the voice of Right of the Chart. Pretty soon we'll be talking to Adam Sarhan. He is the brains behind Right of the Chart. Adam is the creator of the A.M.P.D trading strategy. The D in A.M.P.D stands for defense. Now is the time for it. It's pretty messy out there in the market, but if you've got your protective stops in place and you have a plan for managing your risk and getting out of the way of the downturn, then that eliminates a lot of the fear that a lot of self-guided independent traders have when it comes to trading in the market. We're going to talk about that. We're going to talk about negative math and the problem that some traders have when they get themselves into a hole, how protective stops protect you from that. We'll talk about that and more today on the podcast. Thanks for joining us. But before we get to all of that, remember that in the market, the past does not predict the future. No results are typical, and there is inherent risk when trading in the market. This podcast is for educational purposes and does not constitute financial advice. It's Friday, September 6th, 2024, and here's what happened last week in the market. So look, there's been a lot of selling all week. It's Friday. It's continuing today. The rally attempt that started in August has failed. It's time to be defensive. It's time to remember that you don't have to always be invested to be successful in the market. You know, it's September, and we're both in Florida, and you and I would both like to walk. That's our exercise, right?
Yes.
And tell me if you felt this, because it's still hot and it's still muggy, and I think it's still too hot in the middle of the day to go for a walk because you get overheated and dehydrated. But the other morning I was out for a walk and I was in the shade and there was a breeze and I could feel a hint of autumn.
Yeah.
It was trying to cool down, right? I'm calling it the September cool down, Adam, and we're seeing the same thing happening in the market. It's a September cool down. We've had our run. It got hot in the summer. And then in July, we had a leg down. We had a little bit of a rally. And now in September, that rally attempt failed. I think by all counts, you told your members of FindLeadingStocks.com, we're on a second leg down. And this is when I'm actually most grateful to be an adherent to the A.M.P trading strategy, because my protective stops have been triggering. I've taken some small losses because I had pretty tight stops on some new positions because I was tentative about the market conditions. I've got other stuff that's still working, and I've been able to raise those stops to lock in the profit there. And I'm prepared for the cool down. And I'm not stressing about losing a lot of money. And that feels
Sean,
good.
Yeah, I love it. So Warren Buffett has 2 rules to investing. Rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. I love that. So in my world, there's 2 things as well. There's capital preservation, and then there's capital appreciation. We all want to make money. That's the appreciation side of it. Okay, great. But what's one of the best ways to make money is to make sure you preserve your capital when the environment is not ideal. So we have 3 things that the market can do. It can go up, it can go down, or it can go sideways, and that's it. It doesn't matter where you are. It doesn't matter the political cycle, the Fed, the SHMED, the economics, the jobs report, inflation, all that is noise. All that matters is that it goes up, down, or sideways. So if you're in sync with the market, in harmony with the market, which is our play on the word harmony, then you can adjust your portfolios, and you don't always have to be aggressive or conservative or moderate. People ask all the time, hey, what type of investor or trader are you? And then bucket you or put a label on you. So you have to be that way all the time. Just to your point, which is brilliant about seasons, things
Mm-hmm.
change. Same thing with the market. The state of the market changes, which you talk about in the book. So understanding the environment you're in and understanding that the state does change allows you to preserve your capital for when the environment is going down. And when the environment's going down, guess what? It doesn't go down forever. And that's the beauty of this business. Just like there's a storm outside, it's not going to rain forever. Just if you
Right.
don't want to get wet, stay indoors until the rain passes and then go outside. Same thing here with the market. So we're definitely in a cautious stance. It's not lost on me, Sean. Last year, July to October, we had three waves down or three legs down. And I said just a few days ago that there's a high likelihood that we're in a second leg down, which means we'll probably undercut August's low if that happens, and or go sideways at least for the foreseeable future until we can get the Nasdaq 100 above the August high. Look at the QQQ of 485.54. Until then, to me, it's just defense. Or if we get a big follow through, a big update on volume, lots of breakouts, but the environment needs to improve. Until then, defense is king. It's paramount. Whatever way you want to do it, defense first, because that defense wins ball games, right? That's going to
Yeah.
help you win.
Well, and I think about like in the book, I got to draw those pictures of the smart money superhero and the dumb money beast, right?
Yes.
And I think smart money doesn't try to force trades when the atmosphere is against it,
There
right?
you go,
There it
Sean.
is.
Thank you kindly for that. That was awesome. And Sean did draw that, by the way, and the other ones as well.
And so I think that's, we talked offline a little bit about, yeah, that's right. So true. Just throwing
It's so
money
true.
into the market when it's not performing. And right now, it's
Mhm.
just not an environment. I think about tides a lot when I think of the market, right? And there are still interesting ideas out there, and there are still equities that are doing well, but it's sort of like a high tide floats all boats, right?
Yes.
When the tide's going out, then the momentum's against you, even if you have a winner, right? And so that's why I've learned for you, like for myself, right? In the book's psychological analysis and it's understanding yourself, I like to give clear red light, yellow light, green light on my trading thing because I've gotten in trouble before where I see a good idea. It's got a nice technical pattern, a cup and handle that I like, but it happens in a period where the market conditions are weak. And then I have one chart on my spreadsheet that's my success, and then I get a whole bunch of red all clumped together. Know what that tells me, Adam? It tells me the market's weak and the ideas aren't working. And so I have to be like, okay, I'm just not until I set in my mind the parameters that I want to see before I'm going to turn that light yellow and take partial trades and tight stops, or turn it green and get excited again. And you talked about that number for the QQQ, the 485, right?
Yeah.
And you taught me too about like a downward uh, what the word I'm looking for, the downward slope over previous highs, the downward
Yeah.
trend line, right?
Yeah.
And I kind of picked that too. Like I think when the QQQ hits 480 as of right now, then I'm going to start paying attention. Then I turn the yellow light on, and then I'm going to watch that to break out. And what's interesting is the longer the market goes down, the lower that downward trend line is going to get as time goes on. But that's the A and A.M.P.D is the advanced entry points, right? So you can watch it hit that downward trend line and then wake up. And it doesn't mean get crazy and start investing again, but that means that we've crossed a threshold. There may be an advanced entry point, and we can start watching and maybe turn our light yellow, or maybe wait for it to break out above the last high, and that'd be a double confirmation on the effort, right?
Yeah. So again, as people watching this, like, what does all this mean? What should I do? What do I buy? What do I sell? Understand, folks, that when you're trading and you're making your own decisions, There are no quote unquote rules where you have to be fully invested at all times. You have to be 100% long, 100% short. You're free to do whatever you want, but the idea is to be in line or be in harmony with the market. So most stocks follow the market. So what Sean's saying here is that if the market's going lower, by definition, most stocks are going lower. So you don't have to be actively buying. You can wait for that storm to pass, for that selling to pass, because this too shall pass. It always passes. And
Yeah,
then what?
you look back, and the periods where the market goes down are shorter than the periods where the market goes up historically.
Correct. And that's not doesn't mean it's going to happen again in the future. But if you look
Right.
at it historically, what happens? If you are caught in those big declines, you get what I call negative math, which we talk about in the book also, where you get stuck with big drawdowns in your portfolio. So, for example, the way math works, and the reason why it's negative math is, let's say you buy something at 100 and it goes down to 50. You just lost 50%. And the stock's at 50 right now. In order for it to get back to 100, it has to go up 100%.
It's got
How
to
many
double.
times does a stock go up 100% after it gets cut in half? It doesn't happen often. So that's negative math, where it goes down 50, needs 100 to go back just to get to even. And as you go down more and more and more, the math, you just need more and more larger gains to get back to even, not to make money, just to get back to even. So
Yeah.
for me, one of the superpowers of investing and trading is to respect risk. Think of it like a Libra scale, or the old-fashioned scales. You have risk and you have reward. Everybody comes into the market, just about everybody, and pulls out a calculator and looks at the reward side of this equation. If I go buy 1 million shares and it goes up $1, I made $1 million. Yippee! I'm going to go buy a Ferrari or whatever it is, pay off my house, whatever. But what people aren't doing, and what gets people in trouble, is looking at the risk side of the scale. Most people aren't doing that. The super
Yeah.
traders, or the ones that are really fantastic, the legends, so to speak, are the ones that are able to stand the test of time and be in the business for decades. They're the ones that respect risk. And they understand that that's a side of the equation that they can control for the most part. So you can enter where you can choose where you enter and where you exit and how much you risk when you're wrong. Most
Yeah.
people don't even think about that. So understanding that, it's a superpower, because now all of a sudden you're not at the mercy of the market or some other external event, the Fed, jobs report, inflation, whatever the case may be, earnings,
Hmm.
schmurnings, it doesn't matter. You have control over where you can enter, where you can exit, how much you risk when you're wrong. For the most part. Now, it could gap down on you. Those are
Sure.
anomalies. But for the most part, you can control that. And if you understand most trades are not going to work, and you keep those losses small over time, you're going to do very well, because you can avoid those big negative drawdowns that most people get stuck into, bear markets, deep corrections, so on and so forth. Then it takes so much time to get out of them. But if you're able to
Right.
shift and get out of the way and bypass that selling, or the majority of that selling, keep your physical capital preserved, the capital preservation, but also your mental capital, because you're not getting beat up as the market goes down. When that inevitable selling passes and that storm's over, you're there and ready to capture the inevitable uptrends that follow. And
Yeah, with your
that
capital
is
preserved, so
magic.
you have the cash on hand to get in. You haven't
And you
blown it
don't have the
all.
big damage. You're not
Yeah.
stuck down 30, 40, 50, 60, 80, 90%, or whatever the case may be. And you
So
have to dig yourself out of a hole that borderline some people can't even dig out of, or it takes years and years, if not
years and
decades, to
years
dig out of.
to make it back. That's the worst. And that's the biggest fear, is that you're going to do that. And so the protective stops is the defensive mechanism that we use to, I like to use the term, get out of the way. When the
Yes.
market turns against you, just get out of the way. Like that old Karate Kid part two, the
Yep.
best defense is not to be there. And so when you have your stops managed well, uh, when the market turns, I just stopped out of the SPY a few minutes ago, right? It might go a lot further down, and I'm not there for it. And meanwhile, it's left the active money in my portfolio all doing well. It shakes out all the losers. I'm left with just the winners, and now I have at that point, that's up that I've got over 50% of the model portfolio in cash right now. Everything else, I have my stop set so that I've locked in profits. I'm not concerned, and I'm paying attention. I want to be around after it bottoms out, ready to take new positions.
Yeah, I mean, look, there's no rules. Like, this is out of the box thinking, because Most people have blinders on. Oh, I have to be fully invested. The market's going down. It's getting cheaper. I should buy more. So on and so forth. You don't
Yeah.
have to subscribe to any of that stuff. Find an approach that works for you. In the book, we talk about what? There's an infinite number of ways to make money in the market. Find one that works for you.
All right, everybody, that's the podcast for today. I appreciate you listening through to the end. It's still U.S. Open time for me. I'm excited about the Tiafoe match tonight. I'm going to do some grilling, some chicken wings for the finals this weekend. We'll be back next week with more. Until then, keep your losses small and let your winners fly.
That is magic.